Here's how to invest $500,000 as a 35-year-old in Canada. I recently helped a couple who had $500,000 to invest because of an equity payout, turn that into $596,000 to invest through tax planning. And I'm going to show you exactly how. So in this example, we're going to start with paying off $20,000 of higher interest debt. So any debt above 4%. We're going to move $20,000 to an emergency savings account that's going to be set up in a high interest savings fund. And then in this case, they have a combined $160,000 worth of tax-free savings account contribution room. So we're going to move $160,000 into the TFSAs. The next step is evaluating whether or not RSPs are appropriate. And in this case, they are, because this is a taxed payout, because it was an equity performance bonus, and the gross was around $900,000 and the net is around $500,000. And because they both have RSP contribution room in the amount of about $100,000 each, they're going to contribute $200,000 or $100,000 each to their RRSPs. That will generate approximately a $102,000 refund, assuming that they're in the highest marginal tax bracket in Canada, because this equity payout was fully taxable. Okay, so if you follow $200,000 committed to TFSAs, emergency accounts, and debt, and another $200,000 committed to RSPs, that's $400,000 altogether. However, because they got the tax refund of $100,000, they still have $200,000 remaining to invest. This is where non-registered accounts come in. And I'll get to that in a second, but first, because they're not homeowners and they opened a first home savings account last year, they have $16,000 worth of contribution room. So we're gonna dump $16,000 each into their first home savings accounts. That's $32,000 altogether. That generates a refund of about $16,000. So now the net remaining for the couple to invest is $184,000. This is going to be split into non-registered accounts equally in each spouse's name, and then invested in 100% equity low-cost funds to ensure that they have good growth potential and don't pay too much in management fees. The TFSA and RSP are also going to be invested the same way as for the first home savings account. That's going to be invested in a lower risk, more balanced portfolio, which is going to ensure that the funds are available and not in too much risk if the market does correct before they buy a home. So in summary, we cut out $600 a month in recurring debt payments. We saved $20,000 to emergency savings, $160,000 in TFSAs combined, $200,000 in RRSPs combined, $32,000 in first home savings accounts combined, and $184,000 in non-registered accounts combined. Quick note, some of this cash will only become available when they file their tax return in the next calendar year. So the total amount invested out of the $500,000 payout is actually $596,000. We've recovered $116,000 in taxes paid on the payout, invested in low-cost equity funds, and helped them avoid portfolio construction mistakes that DIYers are prone to make.